Welcome. This is Dr. J. Kent Gregory, and this is a continuation of the discussion of mutual funds and other investment companies. In this section, we'll talk about money market funds and we'll go through stock funds. And this is coming from Chapter 4 of Jordan, Miller, and Dolvin's Fundamentals of Investments, ninth edition. So money market funds, also known as MMMFs, specialize, as the name would suggest, in money market instruments. Most invest in high quality, low risk instruments with maturities of less than 90 days. These include government and treasury funds, uh, buy only very short term US government securities, virtually risk free. And then there are prime funds. They buy a variety of US government and non government securities. So they entail some risk, but again, very, very low risk. Money market accounting, just a note. The NAV of a share always equals $1. So as the fund generates more interest, more shares are given to the owners. And this is purely an accounting gimmick to make them look like, or money market accounts look more like bank accounts. And as long as the fund invests in safe, interest-bearing, short maturity assets, the NAV will not drop below $1. Now, there is the case of, or the rather rare case of breaking the buck. This is the rare occasion when the NAV drops below $1. And this happened in 2008. And notably, it happened to the Reserve Primary Fund on September 16th of '08. Money market funds are either taxable or non-taxable. As a general rule, interest earned on state and local government, i.e. municipal securities, are federal tax exempt free. And because of their favorable tax treatment, tax exempt funds have lower interest rates, also known as lower yields. Now let's look at a kind of a counterintuitive example. Consider a taxable money market fund that offers a 2.4% interest rate and a similar one, but that's in a similar one, a tax exempt rate that offers 1.6% interest. So if you're in the 30% tax bracket, then the taxable fund is paying 2.4 times, and then in parentheses, 1 minus 0.30, close parentheses, and that works out to be 1.68% on an after-tax basis. So it's actually a slightly better investment than the tax-exempt one. So stock funds, a little background, and we'll talk about one type, or we'll start talking about what I would call type 1. So historically, mutual funds were divided into three categories: stock, bond, and balanced funds. And now it's increasingly difficult to divide these funds into those three categories because of the complexity of funds, but also in the different ways that funds are classified or that funds classify themselves. So there are a variety of stock funds. The first one we'll talk about is type 1, or what I call type 1. And this is capital appreciation versus income. So capital appreciation seeks maximum capital appreciation, which equals the best prospect for stock price appreciation. They don't really look at dividends, company size, or country. And they'll even consider companies that are out of favor, because really what they're looking at is an increase in the stock price. So if a company is, relatively speaking, has a low stock price now, but has the future potential to gain in stock price, then that would be a good candidate for a capital appreciation fund choice. Growth. These type of stock funds seek capital appreciation, but they invest in larger, more established companies, so are less volatile. Dividends are not important. Then there are growth and income funds. Capital appreciation is the main goal, but part of the focus is on dividend-paying companies. And then equity income. They focused almost exclusively on stocks with high dividend yields, thus maximizing the income of the portfolio. Type 2, company size-based funds. These are small company funds, where small refers to the total market value or capitalization of a stock. It's often called small cap funds. And small is a variable term. It can mean anywhere from a market cap of $10 million up to $1 billion in total market value. Uh, Small companies typically don't pay dividends, so this type of fund, the focus is on capital appreciation. Mid-cap funds, they invest in stocks that are too small to be in the S&P 500 index, but too large to be considered small cap. And then now there are funds that invest in both small and mid-cap funds, and they're called, funnily enough, mid-cap funds. And then large capital funds. These funds invest in companies with large market values, most in excess of $10 billion. Stock funds, type 3, international funds. So diversifying internationally has proven or that it can improve rather risk return trade-off. So there are two types. There are global funds, which have large international holdings, but also do keep significant investments in US stocks. And then there are international funds, where the focus is on non-US equities only. So some international funds focus on specific regions like Europe, Pacific Rim. Some specialize in individual countries that have a stock market, no matter how small. And of course, those can be relatively volatile. There are also emerging market funds. These specialize in countries with small or recently established stock markets. Also note that these are volatile or have the potential for being volatile. And then frontier market funds. These specialize in the smallest and potentially most risky of emerging countries. And then a note here, some funds are not classified as international, even though they are, but are classified as growth. So again, we can see that funds can fall into numerous or two categories at once. And then to round out our discussion of long-term funds, we'll talk about type 4, what I call type 4 sector funds, and type 5 other fund types. So sector funds specialize in specific sectors of the economy, often a particular industry or commodity. By their nature, they're not diversified, and they can be high performing depending upon what sector is hot at the particular time. But again, the opposite can occur. And then type 5, other fund types. There are index funds. These hold the stocks that make up a particular index in the same proportion as the index. These are passively managed. And the 10 largest funds in 2019 were index funds in the US. Social conscience funds. These are a relatively new type. They invest in companies whose products, policies, or politics are seen as socially desirable according to some criteria. They're also known as social responsibility funds or ESG funds, which stands for environmental, social, and governance. There are SIN funds, and then there are tax managed funds to round out the other fund types. Tax managed funds try to hold down turnover to minimize realized capital gain, and then they try to match realized gains with realized losses, thus minimizing the tax liability. So an example of a SIN fund is the Vitium Global Fund by USA Mutual. And Vitium, just a little bit of a trivia, Vitium is the Latin word for vice. In fact, that's where we get the word vice. And this specializes in aerospace and domestic, defense industries, gaming industries, manufacturers of cigarettes, tobacco products, and then alcohol producers. So there you go. Well, thank you very much for joining me, and I hope this was interesting. I hope you learned a lot. Bye bye.